Imagine a company manufacturing like heavy physical metal boxes, right?
Right.
And they're shipping them across the world on cargo planes, managing this massive, complex global supply chain.
Which is incredibly expensive to do.
Exactly. But somehow at the end of the quarter, they pull in the profit margins of like a pure software application.
Yeah, which historically, I mean, that's impossible.
It is. Hardware has a massive physical overhead, and software has infinite scalability. Never the twain shall meet, bro.
Usually, yeah.
But today, we're looking at a company that hasn't just crossed that barrier, they've entirely shattered it. Welcome to today's deep dive. We are unpacking a staggering stack of financial research, 10K filings, and discounted cash flow models, all centered on NVIDIA's Q1 fiscal year 2027 earnings and their long-term valuation.
It's arguably the defining financial puzzle of the decade.
It really is. The goal here is to shortcut all the market noise and figure out if this is just a classic bubble ready to pop or, a modern value investing masterpiece.
Because we're looking at a scenario where the sheer velocity of capital formation is just testing the limits of traditional valuation models.
Oh, absolutely. Now, before we dive into the mechanics of those models, I need to share this quick message with you. To access more advanced researches, applications, and our latest published personal intelligent, multi-agent, deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store.
Right.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated. Okay, so where do we start with this?
Well, to set the baseline for our analysis today, all the sources we are looking at cover financial data ending April 26, 2026.
Got it. Which is super recent.
Yeah, and that's crucial because we aren't dealing with optimistic projections here or like 5-year forecasts. We are looking at the hard data of what has already materialized in the first quarter of fiscal year 2027.
Right, it's real money in the bank.
Exactly. And it perfectly captures the absolute scale of the global transition to, generative AI and accelerated computing.
Okay, let's unpack this because I want to anchor this with the top line number.
Oh, yeah. The Q1 FY 2027 revenue,
Right. It hit 81.6 on $5 billion.
which is just wild.
It's an 85% year-over-year growth. Like, these numbers look like a typo. It's like looking at a legacy hardware manufacturer, but seeing the profit margins of an elite software company.
It really is. And to put that magnitude in perspective, their data center revenue alone is nearing a $200 billion annual run rate.
200 billion just for the data center.
Just the data centers. That segment by itself is larger than the entire GDP of some mid-sized countries. And, it represents a fundamental structural shift in their identity. We can see this detailed extensively in their fiscal year 2026 10K summary.
Right. The 10K breaks all of this down.
Yeah. Out of their total annual revenue for FY 2026, which was nearly $216 billion, the data center segment made up 89.7%.
Okay, wait. So traditional gaming, like the graphics cards that built their cultural brand in the first place, that's basically just a rounding error now.
Pretty much. It's down to just 7.4% of total revenue.
That's crazy.
Yeah. They've completely morphed into an enterprise AI infrastructure provider. But the true anomaly, the thing that is just breaking the historical precedent of the tech sector, is their gross margin.
Oh, the JAP gross margin, right, sitting at roughly 75%.
Yes, 75%.
Which brings me back to that hardware versus software paradox. Generating a 75% gross margin while scaling revenue by 85% year over year.
While physically manufacturing hardware systems.
Exactly, it's unheard of. And it generates so much cash that in a single quarter, they recorded $50.3 billion in operating cash flow.
In one quarter.
One quarter. And they returned $20 billion to shareholders through buybacks and dividends, hiked their dividend 25-fold, and authorized another $80 billion share repurchase with no expiration date.
Because the top-line expansion is directly translating to the bottom line without getting, eaten up by proportional costs.
Right.
I mean, GAAP net income for the quarter reached over $58 billion. They are operating with the capital efficiency of a lean startup, but at the scale of a global hedge fund.
Here's where it gets really interesting, though. Those margins are incredible, obviously, but they immediately make me wonder how they survive competitor undercutting.
Yeah, that's the classic question.
Because in any normal market, if a hardware company has 75% margins, that is blood in the water, right?
Right.
Competitors rush in, they drop their prices by 30%, steal the market share, and the margins collapse.
Which is exactly what economic theory says should happen.
So why doesn't a competitor like AMD just slash their chip prices and take the business? So they aren't just selling the pickaxes for the gold rush. They invented a specialized language that you have to speak if you want to mine the gold at all.
Right. And what's fascinating here is that assumption most people make, that code is just code, fundamentally misunderstands the product.
Right.
The true economic moat isn't actually the silicon itself. It's the software ecosystem built on top of it.
The CUDA platform.
Exactly. The Compute Unified Device Architecture, or CUDA. They launched CUDA way back in 2006 as a proprietary parallel computing platform.
Wow, 2006, so they've been building this for a while.
Decades.
Yeah.
And over the last 2 decades, it has become the absolute default programming language for deep learning.
Yeah, the sources mention that more than 98% of machine learning developers optimize their models directly for CUDA.
98%. It's a total monopoly.
But wait, open source communities are relentless, right? Hasn't anyone tried to build like a universal translator? If AMD offers a chip that's significantly cheaper, won't developers just take the time to rewrite their code or use a translation layer?
Well, here's the thing. In AI training, time is literally money.
Okay.
Translating code on the fly, or using imperfect workarounds, introduces latency. When you are renting tens of thousands of GPUs at hourly rates to train a trillion parameter model, a 10% drop in efficiency costs you millions of dollars in compute time.
Oh, wow. So you can't afford the translation delay?
Not at all. Think of Kita like the QWERTY keyboard. It might not theoretically be the only way to arrange letters, but the entire global workforce has deep muscle memory for it.
That's a great analogy.
Asking a team of elite AI developers to suddenly switch to AMD's ROCm platform or Intel's One API is like asking a concert pianist to perform on an instrument where all the keys have been rearranged. The switching costs are structural and massive.
That makes perfect sense. It's not just having a faster chip. It's that the global workforce of AI developers is already fluent in your proprietary language.
Exactly.
Yeah.
And they reinforce that software moat with a physical barrier to entry that competitors are really struggling to match.
Which is what?
System-level architectural co-design. NVIDIA doesn't really sell a standalone GPU anymore. They architect the entire supercomputing node.
Okay, let's break down the mechanics of that. The sources highlight their custom Grace CPUs and their proprietary NVLink memory pools.
Right.
Why does that system-level design matter so much to the end user?
Because AI models have grown so massive that they can't physically fit onto a single chip anymore.
Aha, okay.
A model might be split across thousands of GPUs running simultaneously.
Yeah.
So the bottleneck in training an AI isn't usually the processing speed of a single chip. It's how fast those thousands of chips can talk to each other to share data.
Because if they can't communicate quickly, the whole system slows down.
Yeah. Exactly. Standard networking cables create a massive traffic jam. NVLink is essentially a proprietary multi-lane superhighway built directly into the server architecture that just removes that traffic jam entirely.
Wow.
And when you combine that throughput advantage with their dominant supply chain scale at TSMC for advanced packaging, you create a fortress. You aren't just trying to beat their chip, you have to beat their software, their networking, and their manufacturing scale simultaneously.
It's an incredible setup. But looking at the SEC filings, though, there is a glaring vulnerability hiding in the fine print.
Oh, absolutely.
Wait, the sources show massive customer concentration? Building an empire on essentially 3 VIPs sounds terrifying. What happens if they just stop buying?
This raises an important question because it's a huge risk factor. If you look at the Q2 FY26 data, they mention customer A and customer B driving 39% of total revenue.
39% from just 2 customers.
Right. And when you isolate the data center segment, nearly 53% of the revenue came from just 3 unnamed customers.
Unnamed? I mean, we all know they're talking about Microsoft, Meta, and Google, right?
Yeah, it's the worst kept secret on Wall Street.
Right.
The customer base has migrated from millions of, highly distributed retail gamers buying individual graphics cards.
Yeah, right. The old gaming market.
To a highly concentrated pool of hyperscalers and cloud service providers building these massive AI factories. And this concentration is the exact issue keeping risk managers awake at night.
For good reason.
It highlights the primary long-term threat, which is the CapEx trajectory of these hyperscalers.
And these hyperscalers, the Magnificent Seven, they are not just taking NVIDIA's premium prices lying down. The research points out they're actively building their own bespoke silicon to cut NVIDIA out of the loop.
Yeah, it's this weird frenemy dynamic at the heart of the industry. Like Microsoft is buying hundreds of thousands of GPUs while secretly designing its own custom chip called Maya.
Right, and Google has its TPUs and Amazon has Trainium.
Exactly. These are custom application-specific integrated circuits, or ASICs.
So wait, if Google and Amazon have the capital and the engineering talent to build custom ASICs, why don't they just dump NVIDIA entirely and run everything in-house?
Well, building a custom ASIC for a specific internal workload is very different than building a general-purpose GPU that the whole world wants to code on.
Okay.
Google can use TPUs for its own internal search algorithms perfectly well. But Google Cloud also rents out server space to external startups.
And those external startups, like we discussed, they demand CUD.
Exactly. They demand NVIDIA. So the hyperscalers are essentially trapped by their own customers' preferences. They have to keep buying NVIDIA hardware to remain competitive as cloud service providers, even as they try to incubate their own cheaper alternatives in the background.
It's a fascinating standoff because if those in-house custom chips ever capture a meaningful share of general cloud inference workloads, or if those giants simply decide they've built enough infrastructure and slow down their CapEx spending.
The revenue could contract incredibly sharply.
Exactly.
There is also a geopolitical layer compounding that risk.
Oh, right.
Yeah, the forward-looking guidance for Q2 FY 2027 conservatively assumes zero data center compute revenue from China.
Zero. Wow.
They are proactively de-risking their pipeline from shifting trade constraints. And, I mean, while that is a prudent management decision, it effectively walls off a massive piece of the global market.
Which brings us to the ultimate puzzle of this deep dive, and where the traditional finance world is completely clashing with the tech world.
Well, this is the best part.
How do disciplined value investors look at a business printing unprecedented free cash flow, protected by a software monopoly, but deeply reliant on the ongoing capex of 3 or 4 tech giants? Do the old valuation rules still work?
Well, if you run this company through the classic Benjamin Graham deep value tests, it fails spectacularly.
Brutally fail.
I mean, deep value investors typically look for a PE ratio under 15, right? The trailing PE ratio here is 44.8.
That is miles outside the comfort zone for a classic value play.
Completely outside of it. And the price-to-book ratio is even more extreme. A traditional value target is a PB under 1.5. This sits at a massive 34.5.
34.5, that's just astronomical.
Right, because the market is pricing in the proprietary software platforms, the developer lock-in, and the intellectual property, rather than the tangible book value of their factories and inventory.
Makes sense.
But because these metrics are stretched so tight, we're actually seeing legendary value investors take evasive action.
Yeah, the research indicates that Stanley Druckenmiller entirely exited his long-term position.
Right.
And David Tepper disposed of the vast majority of his holdings. Terry Smith exited completely, specifically citing concerns about that customer concentration we just discussed.
Yeah, they're seeing the risk and pulling back.
The source also explicitly notes that Michael Burry actively shorted the stock in late 2025 and early 2026. He isn't just avoiding it, he's betting against it.
He is anticipating a structural valuation, multiple compression. These investors are looking at the massive sector-wide run-up and seeing a total violation of the margin of safety.
So what does this all mean? Are the billionaires right to run away, or are they trying to navigate a brand new world using a very old map?
Yeah, well, if we connect this to the bigger picture, there are other ways to measure a company's trajectory, and that's where the deep value paradox emerges.
Okay, tell me about the paradox.
While it fails Benjamin Graham's tests, it actually passes Peter Lynch's tests with flying colors.
Really? How so?
Lynch focuses on the PEG ratio, which adjusts the PE multiple for the company's actual growth rate. A PEG under 1.0 is generally considered attractive.
And what's NVIDIA's?
Despite the massive run-up in stock price, the PEG ratio remains incredibly low at 0.68.
Wow, 0.68. That's surprisingly low.
Right. This suggests the market might actually be underpricing the sheer velocity of its long-term compounding. Add to that a return on retained earnings of 84.1% over the past decade.
84%.
For every dollar management decides to keep rather than give back to shareholders, they're generating an 84-cent return. That is phenomenal capital allocation.
And let's get into the mechanics of the discounted cash flow model, the DCF, because this is where the rubber meets the road on valuation. The sources provide a detailed base case. How do the assumptions actually hold up under scrutiny?
The base case DCF is incredibly revealing about what the market expects. It starts with an assumption of $96.6 billion in base free cash flow, which aligns with their audited FY 2026 numbers.
All right, almost $100 billion in free cash flow.
Yeah. Then it models a 10-year projection period, fading down from 25% growth to 12% growth, a 3% terminal growth rate, and applies a 10% discount rate.
Got it.
Under those specific conditions, the intrinsic value comes out to $193.09 per share.
Okay, let's unpack those assumptions. A 10-year fade from 25% down to 12% growth. Is that realistic in a world where Microsoft and Google are actively trying to bypass them?
It's debatable, for sure.
Right. And a 10% discount rate implies a certain level of safety. If you're a risk manager looking at a company relying on essentially 4 customers for its survival, you might demand a 15% discount rate to account for that concentration risk.
Exactly.
And if you plug a 15% discount rate into that model, the intrinsic value plummets.
That is the exact tension in the model. The 10% discount rate assumes their moat is impenetrable. Based on that 193.09 intrinsic value, and with the stock trading in this data set, around $223.47.
Right, it's trading higher than the intrinsic value.
Yeah, it currently lacks a traditional 30% margin of safety. To achieve a textbook margin of safety, a value investor would need a buy price closer to $135.
Wow. So at 223, you are definitely paying a premium.
You are. However, the analysis concludes that despite the premium, it acts as a Buffett-style compounder. It's an extraordinary business trading at a fair, if somewhat stretched, price.
But there has to be an underlying condition for that math to work out over the next decade.
Oh, absolutely. The underlying condition is macroeconomic. That valuation only holds up provided the global AI factory build-out scales to a $1 trillion addressable market by 2030.
$1 trillion by 2030.
It assumes every major enterprise, government, and cloud provider continues to build out infrastructure at an exponential rate, and that the company flawlessly executes its future architecture roadmaps, transitioning smoothly to their next-generation platforms without any manufacturing hiccups.
That is a lot of things that need to go perfectly right.
It is a price-to-perfection scenario.
So, to summarize the journey we've been on today, we are looking at a company that has successfully transitioned from selling hardware to a fragmented consumer market right into a full-stack, software-moated AI juggernaut.
Perfectly said.
They are generating unprecedented free cash flow, over $96 billion in a single year, and operating with software-like 75% margins.
It's historic.
But the trade-off for that growth is severe customer concentration. If you're an investor, you aren't just betting on their engineering. You're betting on the sustained, uninterrupted capital spending of a handful of massive tech giants who are quietly trying to build alternatives.
That captures the dynamic perfectly. And, there is one final lingering variable I'd like to leave you with.
Oh, what's that?
We spent a lot of time discussing the QWERTY keyboard analogy, right? How QTUDA is the absolute standard for developers today, and how that muscle memory protects their margins.
Right, it's the language you are forced to speak if you want to operate in this space.
But as these generative AI models become exponentially more fueled by the very clusters of GPUs we've been discussing, their coding abilities are skyrocketing.
Oh, man. I see where you're going with this.
What happens when the AI itself gets so smart that human developers stop writing the code entirely? What happens when a generative AI can ingest a prompt and instantly output perfectly optimized machine code for any hardware architecture, like instantly translating between NVIDIA, AMD, or custom Google silicon without any latency?
If an AI can act as a flawless, instant universal translator, the switching costs literally disappear.
Exactly. The provocative question is, could the AI eventually bypass human-written legacy platforms like CUD entirely? If the machines learn to navigate the hardware on their own, does the software moat evaporate overnight?
That is, wow, if the machines build their own map, the old map doesn't just shift, it becomes entirely obsolete.
Exactly.
That is a brilliant and slightly terrifying thought to chew on. Well, thank you so much for joining us on this deep dive. Keep questioning the assumptions in the models, keep looking beneath the surface of the headlines, and remember, even when the historical rules seem completely broken, the underlying mechanics always have a story to tell. We'll catch you on the next one.